Hi friends, today in this video we will discuss about technical analysis and fundamental analysis. What is technical analysis, what is fundamental analysis, and which one we should use. Okay, so let's start. Fundamental analysis deals with the business and technical analysis deals with the price. Basically, whatever we are trying to analyze, there are only two things about the stock market that we can analyze. Either we can look at the company itself, what the underlying business is doing, or we can look at the price and we see what the price is doing. So what fundamental in fundamental analysis, what we do, we look at the business itself. What is the sales, what is the revenue, what is the return on capital employed, what is the debt. All those things we look in the fundamental analysis. So let's see how we can do it. So there are three stages in the fundamental analysis. One will be the past data. So how the company has done in the recent past, in the recent years and in the recent quarters. Then the present, what is happening presently in the company, and then the future. Because we don't have any data about the future, we have to anticipate what might happen in the future. So now let's look all the three stages how we can do. Past data is very simple. We can find it in the internet. Let's say we want to analyze this company called Asian Paints. Okay, so there are various fundamental terms. However, we'll look at the top three or four or the most important parameters when we are doing the fundamental analysis. So one of the very key term or indicate term or ratio that is used in fundamental analysis is return on equity. As the name suggests, it is the return on the equity. That means the company as a whole, how much in percentage is able to generate, it is able to generate in the how much the in total, whatever is the equity of the company, how much percentage of return the company as a whole is generating is called return on equity. You can consider this as the the return given in the fixed deposit or in the savings account. Let's say you want to open a saving account. Okay, you have two options. One bank is providing 5% per year and another bank is providing 6% per year. So it is very simple. If you want to open a saving account and your main criteria is to get the return, to get more return, obviously you will choose the bank who is providing 6% of return. Similarly, return on equity, when you are comparing two companies or standalone, you are looking at a company, this is the in percentage term how much in the total capital the company is able to generate, how much the company is able to generate in profit, that let's say after everything. So in this case, last 10 years this company has generated 30% return on equity. That means is if the company had 100 rupees every year, on average it is able to generate 30% per year. Last 5 years return is similarly 27. Last 3 years average return on equity, it is not the return, it is the return on equity. So basically this will also translate into the share price. That's what fundamental analysis considers. It might not exactly translate into the the final price of the stock, but this is how we have to analyze based on return on equity. So if a company is able to provide more return on equity, that is better. And in the short term, if the company's return on equity is more than the long term return on equity, that is also good for the company. Okay, so few key things we can see is, as compared to your fixed deposit, let's say the prevailing rate of fixed deposit here is now 8%. So if you want to invest in a company, it should be able to generate return on equity more than 8. Basically, you can take anything around 15-20% per year as return on equity to consider the share or the company as a good company. So here if you see, the return on equity is good. However, if you see as compared to 10 years, the 5-year return on equity is less, and as compared to 5 years return on equity, the 3 years return on equity is less. However, we will not go into the detail. What we are trying to see here is few key terms, indicators or parameters that we should look into when we are doing a fundamental analysis. So we saw what is return on equity. Return on equity is the return the company as a whole is able to generate on its total capital. That is called return on equity. So the more the return on equity, better the company is. And also in recent years, the return on equity should be more than the longer term average. So that's what we understood from return on equity. And you should look any company which is able to generate at least 15 to 20% or more than that as return on equity. Okay, now that is on return on equity. After return on equity, there is also one very important thing is debt to equity. How much debt the company is having. Okay, so if you look at this company, debt to equity is, you can consider it as 0. So if it is 0.1, that means in every 1 rupee it has 10 basis point of debt. So if it is generally it should not be more than 0.2. That means if the total capital of the company is 100 crores, there should not be debt of more than 20 crore. However, there is no static rule on this. You have to look at the particular business. If it is a new company, is it taking the loan because of that, all those things. But again, here we are not going into the detail of the term. What we are trying to understand, some key parameter and how to use them. So we just discussed return on equity. Now we are discussing debt to equity. Debt to equity means how much debt the company is having as compared to the total equity. So here in this case, if the company is having one rupee or $1 of equity, this total will be, this debt will be 3 basis point. So if it is a 1 rupee company, only 3 paisa is the debt. So this is very good. It is close to 0. So as a parameter, you can see the debt to equity of the company should not be more than 0.2, that is 20%. Okay, so this is debt to equity. Now you can, after you have seen that, few other things that you can look at is the market cap to sales and profit to sales. I'll explain what is that. Now this total market cap is 1,68,000 crore. Okay, so let's say you want to buy the whole company and it is for sale. That means the total money you have to pay is 1 crore 1,68,000 crore. So now we'll look at the sales. How much is the sales per year and how many years it will take to recover that. So anyways, we are not going into detail, just we are looking at market cap to sales. So 1,68,000 is the market cap, and if you see the yearly profit and loss, this is the sales. So this is the this year total sale is 20,000. So if you 20,000 crores. So if you divide this 20,000 crores with this total market cap, okay, it will take around 8 years of sales. Okay, so market cap to profit is around 8. Okay, so based on, you can decide 3, 4 or 5, whichever is good, but this is the market cap to sales should not be too high. Okay, that means whatever is the sales, the market cap is so high that it will take longer year to to get profit. Okay, but that is a very basic way of analyzing this. However, there are many companies where market cap to sales will be very high because the company is able to generate good profit. That's why people are ready to pay more for the company. That's why the market cap to sales will be high. Again, we are not going into detail, but this is also one parameter that you have to see when you are buying a company or you are investing in the company. Whenever you are buying one share or you are buying the total company, the analysis should be the same. Okay, so you should look at the market cap to sales. One more thing you can look at is the market cap to profit. So market cap again same, 1,68,000 crores. and then if you look at the profit, net profit, it is 2000. So similarly it will be around, I know, 80 times or something. Okay, so this is also one thing you can look at. So you can look at return on equity, debt to equity, then market cap to sales, market cap to profit. Okay, so these are few of the ratios that you can look. Now coming back to yearly data. So if you now what you can see, what is the sales, what happening to the sales of the company year on year. So here we have the sales of this company from 2011 to till 2019. If you look at the sale, it is increasing 7,000 crore, 9,000 crore. Then on 2013 it is 10,000 crore. Then on March it is in 2014 it is 12,000 crores. Then it is 13,000 crore in 2015. Then it is 14,000 crore in 2016, and in 2017 it is 15,000 crores. Okay, in 2018 it is 16,000 crores. Similarly in 2019 it is 19,000 crores. So if you look at the sales, it is increasing from 7, 9, 10, 12, 13, 14, 15, 16, 19. So here is a company, every year it is increasing its sales. So this looks to be a good company to buy. Okay, again there are many details, so we will not go into everything. Then next important thing that you can look at is the net profit, this line, this highlighted line, right? So if you look at this line, 843 crores, 989, then 1100, 1200, 1300 crores, so then 1700, 1900, 2000 crore, 2100, and this is till this year, till the last quarter. So it is increasing. So we saw that this company's sales is increasing every year, and the net profit is also increasing every year. So this is, now you can, let's say you decided to buy the share of the company. Okay, this is on yearly basis. Now we'll go to the quarterly and we'll see what is happening to the recent quarters. Again, in quarterly also we can just look at the sales and the profit. Now if you look at the 2-3 quarters, 5,000 crores, 5,100, 5,000, 5,400, this was in the last quarter. Similarly, so it is increasing. If you see, the trend is increasing. Okay, there will be minor fluctuation, but as long as it is not huge difference, you can consider it as same or insignificant change. Net profit also last 4 quarters, 400 crore to 655 to 823, and this is the current year still running. So if you see, quarterly also it is doing good. Now once you decided based on all these parameter, based on return on equity, your debt to equity, market cap to sales, okay, market cap to profit, then yearly sales, yearly profit, then you come to quarterly sales, quarterly profit. After all these things, once you decide to buy, okay, then you have to be careful on 4 days in a year. Every stock has 4 important day in a year, that is the 4 quarterly result. So as soon as the result comes, you have to look if the sales has increased or not, and the profit after tax has increased or not. If there is a decrease, why? Have they spent on the advertising part, or there is a litigation or any case going on the court because of which they have to pay? So now you have to go into the detail every quarter, and let's say you have bought the company, you have bought the shares, and now during one quarter you saw that there is something wrong happening, and that how you will be able to know from the numbers that the profit or the sales is decreasing and there is a increase in expense. Then you have to see what is the expense for, and based on that you have to decide whether you want to continue to hold the shares of the company or you want to sell it up and buy something else. Okay, so this is how you have to do the analysis based on the past data. Present, what you can do presently, once you have bought the shares of a company, you have to analyze the quarterly result. Okay, that is one thing you can do. Next thing is you have to keep an eye on the management. Is there any case against the management that is put? So you have to be very vigilant about what's currently happening with the management. Okay, again you have to be very vigilant about the current industry. Let's say this is the paint industry, so you have to look if the government is bringing any new tax, any new rule for this industry. So you have to be very careful about this industry. Then you have to see if something particular happening to this particular stock. any news which is only for this, not for the sector, but only for this particular stock. Okay, so this is presently you can day to day, or quarter to quarter or monthly basis you can monitor. Now future, what you can do for the future? For the future you have to see, is there any significant change that is happening, that might happen in this sector? Is there any significant change that can happen with respect to the stock? Will there be a technological disruption which will affect this company? So now the the past data and the present data, you can go into data and you can see what is happening. In the present there are few things which is subjective, like what is happening in the management, or some, or any new rules coming from the government, that will be subjective. But mostly the past and the present data, you can rely on the data itself, what the company is publishing, the quarterly result and the yearly result. Now for the future it is objective. You have to think, you have to be a thinker, who what changes can come in this industry, or what changes can come for the particular structure. Let's say for example auto sector, you have bought, let's say, Tata Motors. Now you have to see, is that okay, there might be electrical vehicle coming in the market in the future. So is this company into electrical vehicle, into electrical vehicle production? Okay, how the competitors are doing in that particular field? Okay, so this you have to see. Okay, now this is how you have to analyze a company fundamentally. And there are two three things here we need to be careful. The data whichever is available by the companies, are they reliable or not? Okay, because we solely rely on that. There are various government bodies who check into that and who ensure the data is correct. However, we have seen the Satyam saga, what happened. They provided wrong data. So that is one thing you need to be careful, that all the data that is being published is correct or not. Okay, and then the current data, when you are analyzing, let's say you want to know the quarterly sales of Tata Motors. Now how can you do that? Can you do that on your own? Can you go to all the cities in the whole country and check with the dealers how many vehicles they sold? No, for that you have to rely on someone else, like some brokerage house. They will provide a report like what are the total sales of the vehicle, of any particular vehicle, and different segment. So fundamental analysis, frankly speaking, for an individual, it is not possible to do it on standalone. You have to rely on few other people. You have to take their service to do this. For example, you cannot go to all the dealers and you cannot get the data on your own, what is the car sales. So you cannot speak to the management. Let's say you come to know that there is some technical disruption coming, the competitors are going into the electrical vehicle. Can you, now you have a doubt whether this company is going into that or not. Can you go to the company, or can you call the CEO and ask that what is your plan? Are you into this? No. Who can do that? Any big mutual fund or any brokerage house, they can approach them, and they can tell, we are generating a report for our clients, which will also be helpful to you, because if our client they might be interested in your company, or they could buy the shares. So even the company will be open to them to provide the detail. But as an individual, if you call any company and ask, hey, I want to know if you are into electrical vehicle, will they respond? No. So frankly speaking, for an individual, it is not at all possible to do 100% fundamental analysis on your own. You have to rely on others. Obviously 60 to 70% or maybe more than 50% data will be available. Based on that you can do the analysis, but you have to leave on the mercy of others to get the 100% data to do your analysis to buy the stock. Okay, so now we discuss what is fundamental analysis. Fundamental analysis is looking at the business, not the stock price. So when we are looking at the business, we are looking at the sales, profit, return on equity, debt to equity, okay, quarterly result, yearly result, any government rule regulation which might come, close eye on the management if they are doing something problematic. All those things that you have to take into consideration to do the fundamental analysis. Now we will look at technical analysis. Okay, so what is technical analysis? Technical analysis is the analysis of the price itself. So what you are doing, you are now looking, you are not looking at anything else, you are just looking at the price itself. Okay, so how you can do that? You are under the assumption that, I mean, technical analysts are always under the assumption that if there is any news in the stock or any news in the business, there will be people who will know that, and they will take decision based on that, and that will be reflected on the price, and we will take decision based on the price itself. So let's say there is a company, okay, and the stock price is moving between 80 to 100. Okay, we'll take a real life example. Okay, what happened recently on Kotak Mahindra Bank. Okay, so let's say there is a company and there is a court case going on. Okay, and you don't know which side will win the case. Okay, if you want to do fundamental analysis, you have to go to the court and listen, or you have to wait for the verdict to be out through the media, and then you take the decision based on that. Okay, however, if you just follow the price, okay, this day on 31st of January, what happened? That RBI and the Kotak Mahindra Bank, there was some conflict between them, and it was resolved, and it was resolved for the betterment of the company. So the stock price opened, gapped up. Okay, so now if you are doing fundamental analysis, you have to understand the judgment, you have to read it, and you have to see what is there in that judgment for the company. But if you are following technical analysis, now you know, okay, now the price is gapped up, there is something, expected. So as the market is going up, or the stock price is going up, it is good for the company. So what's technical analysis take into is, price has everything. Okay, they call, price is the ultimate truth. Okay, so what technical analysis consider that everything that is there about the business is in the price. So we have to take decision based on the price itself. So fundamental analysis deals with the business, what is happening to the business. They are not worried about the price, because what they consider, or what fundamental analysis considers, is whatever is happening in the business, that will eventually be reflected into the business. So let's say there is a company which is 500 crore worth of company. Okay, and next 5 years the profit is going to be double. Let's say the company is having 500 crores of profit today. After 5 years this profit is going to be double. So as per fundamental analysis, the price itself will at least be double. That is how fundamental analysis work, or think, or analyze. Now technical analysis, what is the base for technical analysis, or technical analyst, what they think, whatever is there in the business, people will know that, they will take decision, and that will be reflected into the price. Okay, so we will, or the technical analysis guy will decide based on the price. So fundamental analysis will try to analyze the business and go more deep into the business side and take decision based on that. Technical analysis will analyze the price itself. It will not go into the business, what is happening to the business. It will just look at the price. Is the price going up? They will buy. If the price going down, they will sell. Is the price stagnant in a range? They will wait for a breakout to buy, or breakdown to sell. Okay, so now we understood what is fundamental analysis, how to do fundamental analysis. Also we understood what is technical analysis. Now we'll see how to do technical analysis. Anyways, technical analysis, we are the main aim will be now to focus on technical analysis, and we will see in this video or in the subsequent videos, and through our daily videos we are trying to do the technical analysis. That is, we are more concerned, or our main priority, or our main focus is to look at the price, and based on that we want to take decision so that we are profitable. So for fundamental analysis we have to look in the price. Okay, we have to look it in the trend. So what is a trend? Again, higher highs, higher lows. This is uptrend. What is a downtrend? Lower high, lower lows. Okay, so that we look in the trend videos. Okay, we look in depth into trend analysis in the trend videos. Okay, that is, there is something called momentum. How to know momentum? There are various indicators. Okay, like MACD, RSI, stochastic. These all things will be used to measure the momentum. Trend can be measured by just looking at the price itself, higher highs, higher lows, lower highs, lower lows, or through moving average, or through, there is one indicator called ADX, average directional index. So based on that we can identify the trend. For the momentum, as we discussed just now, MACD, stochastic, RSI, and there are various other indicators that can be used to check the momentum. So in technical analysis we are looking at the price, we are looking at the speed of the price, with what speed the price is moving. So to know the speed of the price we are using the momentum indicators. Okay, so based on that we will take decision and we'll buy or sell the shares. So that's what for today's video. So we discuss about fundamental analysis, technical analysis, and what fundamental analysts do and what technical analysts do. Okay, now important thing is what is the right thing to do. Okay, like in the medical field there is something called allopathic and ayurvedic. So if you take one kind of medicine you can't take the other kind of medicine, because the body, it is not possible for the body to take both the kind of medicine, right? But if you want to buy some shares, right, it is not that you cannot use both. Many people go into the argument which is good, which is bad, or which is better. Obviously everything has its own advantage and disadvantages, right? As we discussed that for an individual it is not at all entirely possible to do 100% analysis. The 50 to 60% data will be available, remaining we have to rely on others. So what we can do, we can take advantage of both fundamental and technical. Okay, so in fundamental analysis, what I consider myself as a techno fundamental guy. So I will be doing technical analysis and little bit of fundamental analysis. In this little bit of fundamental analysis, what I can do, I will not go deep into the fundamental analysis like sales, what is the where is the sales dropping, what is the new product coming, and I mean not into that, but on a high level. Okay, what is the, if the quarterly result has come, what is the sales, what is the profit. Okay, and on a high level of return on equity, debt to equity, all those things I will look into that. However, as I trade the index, I generally look at, is there any fundamental trigger for the company or the index. Let's say budget was coming, so we have to be careful, something can come in the budget. Or let's say RBI policy day is there, so we don't know, or what the outcome will be. At least we know there is a RBI policy day, so we need to wait for the policy to come. And after that, rather than looking at the policy, how much was the cut, we look at the price to take the decision. So first thing is how to use, you can use both, sweet thing of both, you can have good thing of both the analysis. Or at least if you are analysis, if you are a pure technical analyst, you can at least be aware of the fundamental triggers when is the result coming. So whenever there is, if you have bought stock and you don't know the quarterly result, then there is something wrong. You should know that the quarterly result is coming, so that you are aware that today there could be significant movement in the stock. Is there RBI policy day in the near future that will impact all the stocks? Is there a budget? Okay, is there election? So this kind of bigger the big fundamental triggers one should be aware of. And if there is any such kind of event is there, after the event, if you are not able to analyze the policy document or the fundamental data, it is better to stick to the price. Let's say something has happened, RBI has taken some decision and the price is going up, that means that decision is good for the market. Okay, recently budget came, market is going down. Okay, that means the news in the project was not so good for the market, and that's why market is taking it in a negative way and market is going down. So you should be now biased to the downside move. Okay, so you can take both fundamental analysis and technical analysis. At the end of the day, color of the money is same. Everyone is in the market to make money. Nobody is here to prove that either he or she is a technical analyst or fundamental analysis, right? So we should do things which make sense, which is logical. Okay, try to take few things from both and take your investment or trading decision, so that end of the day you are profitable, and that is what matters, right? So if you are interested more about the technical analysis, do watch out my next videos, and I'll upload more videos on trend, and then moving averages, and the money management, trading psychology, and momentum indicators, and many other things related to trading. Thank you, thanks for watching.